Hey, it's Rowan here, and I just wanted to officially welcome you to PTG. I'm really excited that I'm going to be able to help you improve your trading over the coming weeks and months, and I really think you're going to get a great amount of value out of what I can hopefully share with you as we move forward over the next few months. Because I've been in this game for a fairly long time now, and I've been involved with trading on all different time frames and with a few different styles. And I truly believe that when you get involved with trading initially, using the order book is probably the most valuable tool you can use to get profitable as quickly as you can. So I'm not going to stray too far from the basics in this video. So if you're a bit more advanced, you may not need to watch this, but if you're quite new, I'm just going to run you through some of the details of trading with the order book, and also a bit more about the approach that we're going to be using and the way trading's evolved really over the last decade in terms of the way professionals trade using the order book. So I'm going to get started with just talking a bit about what the order flow is all about and how it works. And the first step we really need to examine is what is the order book, and what is it really sort of representing? And if you've never seen it before, it's pretty strange to actually look at. And just looking here at this sort of image of a futures contract, I believe this is a bond future. And if you haven't seen it before, on the left we've got the buyers, and on the right we've got the sellers, and these are called bids and these are called offers. And if you're very, very new to it, the way to remember it is you buy low and you sell high. So if you're ever trying to buy, you want to get the best price you can, so you're trying to buy low, and if you're trying to sell, you want to sell as high as you possibly can. And that's how you remember it. So we've got the buyers on the left and the sellers on the right. And as traders, our goal is to obviously buy something and for it to then increase in price and sell it later on. So we can use the order book to try and identify places where price is going to go from down here to up here. So we're buying low or we're selling high. And with futures contracts, it's very easy to do the opposite. We can actually sell initially and then buy it back. So that's called trading to the short side. And the opposite is true if we're trading long. We're buying low and we're selling high. So if those terms are a little bit confusing, don't worry about it. They're pretty basic, but all they mean is really we're trying to make a profit by the market going up or the market going down. And with the order book, we have a pretty big advantage over people who are trading from charts or just trading on fundamentals or technical data or whatever it might be, because this is a really intimate view of the markets. We're sort of looking beneath the market to seeing, and we're sort of trying to predict the future, I guess, of what's going to happen in the next sort of 5, 10, even 20 minutes ahead, with looking at the buyers and sellers to trying to determine what the market's going to do in the next few minutes. So the way it works is that we can look at the bids and look at the offers and look at the prices that are trading. And this column here is what we call the volume at price. And you can see here that there's 71 contracts, and that means that there's been 71 contracts that have traded at this price level, in that moment in time. And these sort of accumulate and they become almost like a histogram. So we can see where all the price action has been occurring. And, this is, if you haven't seen it before, it's very, very confusing. And I remember when I first saw it, it took me quite a long time to get my head around and really understand just what was going on. So it's certainly not easy if you're brand new to this, but you've just sort of got to bear with it and give it some time. And in a few days, it'll become pretty obvious what's sort of happening. But initially it's very difficult to understand. And the whole premise of what we're about when we're trading with the order book is that we're trying to identify spots where people with large orders, so this might be hedge funds, this might be just big traders, this might be big commodity traders, people who are trying to hedge their positions, whatever it might be, these guys are coming in and they have a large amount of contracts that they need to trade in a certain amount of time. So we see here that sitting on the bid at the moment, there is 262 contracts that need trading. Imagine there's a guy who has 10,000 contracts that he needs to buy, and he needs to buy that in the next 30 minutes for whatever reason. If you think about what's going on, how's that guy going to achieve that? How is he going to execute all those trades at that point in time and do it in the best fashion for him so he can make money as well? Like if you think about it, if this guy has 10,000 contracts he needs to buy, his options are that he can put a limit order in here at 124.09 and just hope that people continually sell to him at that price, or he can hit a market order which would take out all these price levels, 10,000 of them effectively, and that would push the price right up there. So in terms of buying immediately, that's the option that these big traders are faced with. So there's not necessarily a perfect solution for these guys, depending on what, how much they have to trade and how quickly they have to do it. But knowing that, we can use that information to our advantage as we can wait and see. And when we start seeing large amounts of contracts trading at certain price points, we can quickly jump in and come along for the ride. Basically, what that means is these big traders are pushing the price and we're just, cashing in on their big moves. And that's effectively how trading works. It's no different if you were, say, a fundamental trader buying a stock. If you wanted to buy a stock, the whole premise is that you buy a stock and it goes up in value. And the stock doesn't go up in value necessarily because, it reached a certain point on a chart or its PE ratio was a certain number. It does so because another big buyer comes in and decides to buy it. And, in the example with stocks, that might be a big mutual fund decides to, buy this particular stock, or a big time trader decides to buy this particular stock and he's executing his trade, and that might take, of course, over the course of a week or a month even. With futures, the same thing might happen, and we're looking for that, but we're looking for these big traders to execute their trades at, a bit of a faster, over a faster sort of time period. So that might be a week, not a week for us, that might be, 5 minutes, that might be 10 minutes, it might be an hour. Either way, we can quickly identify where these kind of spots are, and what we can do is we can jump in, we can place orders, and we can quickly ride the buying that happens, or conversely the selling that happens, and we can make a quick profit and do so by risking a relatively small amount to make some quick ticks. So effectively, that's the whole goal of using the order flow, and that's why it's so valuable, and that's why people trading off charts and using technical analysis and things, they're really not seeing the entire picture of what's going on. And if you ever go to a professional trading firm or you see photos of a professional trading firm, it's basically just rooms and rooms of people looking at heaps and heaps of these order books, which they can also be called ladders or depth of markets or the order book or whatever it is. But it's basically people looking at all these ladders and waiting pretty much for opportunities where there's buying and selling coming in, and there's a slight sort of opportunity to dive in and make some quick profits. And that's in essence what professional trading is all about. So if you've ever heard people talking about trading Forex and making all this money, or using special signals and all this kind of thing, to me that's not really how it works at this kind of level. Sure, increasingly we are seeing more and more quantitative trading taking place, and I've done a fair bit of that myself, but like I say, the quickest and most effective way for you to start becoming profitable by trading is to sort of get a really good grasp on spotting these buyers and sellers, because we can set ourselves up to get some pretty good risk and reward situations. So that's what we're all about, and that's what I'm going to be taking you through over the next few months, and really getting you up to speed with everything that you're going to need to know to understand how the order flow works, and finding these profitable opportunities where we can spot these big buyers and big sellers, and we can cash in on what they're doing, because that's, at the heart of it, that's how professional trading works. So order flow trading has really been around for decades and decades, even before there was electronic trading. Basically what the guys in the pits were doing to make money was that they were waiting for these big traders to come along, and they were just jumping in front of them. And in the instance when they were trading in the pits, it was a bit different, because it really mattered a great deal when you were getting your fills. So if your best mate was the guy who was calling out all the orders, and he could slide you in front of these big traders when they were trying to execute their trades, then you could pretty easily make some quick ticks. And fortunately, that sort of trading has really gone away, and things have turned over to electronic trading. So if you want to use the order flow to make money, you really need to be staring at a ladder or a depth of market and getting a feel for how the order flow works. And when electronic trading first started coming around, it used to be a little bit different because it was a new thing and we could really scalp back then. So what that meant was we could really look for these big buyers and these big sellers, and whenever we saw one, we could really jump in, grab one or two ticks, which was just really one or two price levels, and we could get out. And it was really pretty obvious. People would come in and they would just plonk these big orders on the ladder, and you could see them clear as anything. And it was really just a matter of front running those orders. And that was, probably a decade or more ago even. And as things progressed, big traders got smarter and technology got better. So these big traders started disguising their orders and not putting them all there at once, and using, algorithms and things to really disguise what they were doing. And, because they need to hide what they're doing, because people like us can identify it and make money from them. And if we're making money from them, that means that they're losing money effectively. And that's really the edge. That's really where the edge comes from. It's really the issues they have with executing these big, large orders is where a lot of day traders can make money. So that's what we're trying to do. We're trying to, exploit the issues that they have with execution. So that was what was initially going on, and people were making quite a bit of money as pure scalpers. And then, as this technology improved and the markets became more crowded and there was more and more, examples of high frequency trading, those little 1 to 2 tick gains, in my opinion, they've kind of been wiped out now, and they're not really around as much as they used to be. And it's not really that easy for order flow traders to be making these 1 or 2 tick gains anymore. And you're also running into the fact that you have to pay commissions, and commissions can really destroy that edge. So from that, we saw a big change to what's called sort of spread trading, and that was using the order flow, but it's really about using correlated markets to try and find an edge, because effectively markets trade in sync. So if you're thinking about two products that are highly correlated, like a 10-year bond and a 30-year bond, those markets are going to move in tandem basically, and the difference between those two markets is going to remain reasonably constant over a long period of time. They're not going to get too far out of whack on a daily basis. So basically people moved from scalping to almost or realistically trading the difference between these two contracts, which is called spread trading. And we could use the order flow again, because if there was a big order coming in on the 10-year note, say, and that pushed prices really high and the 30-year was lagging, then there's a little tiny difference there, and you could scalp out a few ticks when that was taking place. But again, like markets do, they kind of change and they evolved, and we saw that this trade, it used to be really, really consistent, and people were making trades that were right 90% of the time, and then and when you're seeing this kind of thing happening, that markets are going to change and they're going to evolve. And basically they broke down, and now markets are very saturated, and these spread trades, they're not really as profitable as they used to be, and a lot of spread traders are now really starting to struggle in what was once the best thing you could be doing. And in my opinion, things have now changed and come all the way back to a point where we need to use the order flow to trade. There's no doubt about it, because we need to find the very best entries and exits that we can. But we need to sort of do a combination of scalping and spread trading. And in my opinion, that's where markets are at the moment. We want to use the order flow to really locate the very best entry points. And we can do that because we can spot the buyers and sellers. But we also need to be using other markets to give us an idea about where prices are going to go, because all markets are correlated to some degree. So we need to find a set of markets that are correlated, so we're getting the best, highest opportunity of success, and we can find these trades that have a really good risk reward. And we're using all the tools that we have at our disposal to try and make a profit from these trading opportunities. So, like I said, these markets have evolved from really basic scalping opportunities to spread trading to now being almost somewhere in the middle. And that's actually a good thing for us because it's letting us use all our skills to make really good trading decisions. And we have some real advantages that, we didn't have a few years ago. So that's really exciting. Now, I just want to talk quickly about the difference between professional trading versus retail trading. So if you're trading at home and you've just got a trading account with a broker, then you're considered to be a retail trader. And the difference between a retail trader and a professional trader is that a professional trader gets really good commissions on their trades, and that's because they're trading through effectively a broker that gives them a really good price because of the really, really high volume, not just them, but their entire firm is doing. And that's a really big advantage because commissions are probably the biggest factor you're going to face in becoming a profitable trader. If you can beat the commissions, you're doing really well. So that's great for professional traders and not so great for retail traders. But at the same time, these professional traders, they're also paying fees each and every month to these professional trading firms, and it's usually in the vicinity of about $2,000 a month they have to pay for all their trading software, for the use of the desk and the rent effectively, and all the services that they need. So that really changes the way that you need to trade. So if you're at a professional trading firm, you really need to do a high volume of trades and to overcome these desk fees and make the most of these low commissions that you're getting. So conversely, if you're a retail trader, you don't get the great commissions, so you have to be a lot more selective in your trades, but you're not really forced to trade as such because you're not paying these huge monthly fees. So there's some advantages and some disadvantages to both, but as most of you here are going to be retail traders, we're going to be playing to our strengths, and we're not going to be taking these high frequency sort of scalps like I was saying in the last slide. We're going to be a bit more selective in our choice of trades, and we're going to play to our strengths, which is we get to really pick and choose the very best trading opportunities that we have to take. So that's a big advantage for us. So that's what I'm saying when I'm talking about the volume and the style. They're really different, but as retail traders, we're playing to our strengths, and we're not going to get caught up in all the tiny little 1 and 2 tick gainers. We're looking for really good risk and reward opportunities. So we might be risking 2 or 3 ticks, but we're getting the chance to make 10 or more ticks. Whereas a prop trader, they're going to have to be pushing every little advantage that they've got, and it's not really as easy for them. So that's what I'll be sort of showing you. I'm not really that interested in the very short-term opportunities because I just don't think they're that practical. I'll run you through how to do that, but as you improve and you find your own sort of style for yourself, I want you to really see that it's more about playing to your strengths, and that means finding really good opportunities that give us a really good high probability of success. So our approach that we're using is kind of a multi-dimensional one, and when we're looking for trades, first and foremost we're interested in the order flow. So we're looking for these sort of positions where there are going to be big buyers and big sellers, and it's our job to really jump on board and go with these guys. We're not trying to fight what the big money's doing, we're just going with it. And to do that, we're going to use our order book and we're going to spot those buyers and sellers. And we're going to use the volume profile that we saw in the earlier slide. We're also going to be using correlations with different markets. So, if we're trading the S&P 500, we want to make sure that all markets are headed in our direction. So that means we want the Dow, we want the NASDAQ, we want everything to be headed in the same direction. We're not trying to fight with these big guys, we're just going to go with them. And that is also the same as the market conditions and the sentiment. If the market's crashing and it's going down, we're only looking to be trading to the downside. We're not worried about trying to pick the bottom of a market that's crashing. We're just going to go with it, and that's going to give us every chance to really find the best possible trades that we can. We're going to be looking at important price levels. So these are levels that are significant. This is a bit different to using technical analysis to identify trading opportunities, because we're using these important price levels to really see what other traders are seeing, and we're trying to get into their heads about other prices where there are going to be these big players involved, and we want to be involved when the big players are involved. So that's one way that we can do that. And another way that we can do that is just looking at, what's going on when the market opens. So if there's a lot of action during the market open, that's going to be a good thing for us. If the markets are really, really quiet, that's not very good, because it's all about finding opportunities where there are big traders out there so we can sort of cash in on what they're doing. And we want to be jumping on board with them and trying to sort of go with what they're doing. It's like if you're a surfer and you're trying to ride a wave. That's what it's all about. So, we're not trying to fight what the big traders are doing. We're just going with them and doing what they're doing. But we're just sort of nipping at their heels and cashing in on the hedge funds. So, that's not always an easy concept to get your head around. It really took me about a week to sort of understand that's the ultimate goal of a professional trader, because I always thought it was about, finding some magical moving average or something like that. It's really not about that. It's about just finding what the big traders are doing and following their lead. So as soon as you can sort of come to that sort of understanding in your head, the faster you become a much better trader. Just having a quick look at the depth of market here, I'm just going to give you a quick overview about how we go about it. So very quickly, we've got the Eurex products here. So these are the bonds out of Europe, and we've got the Bobl, the Bund, and the Schatz. So these are all bonds with different durations. So this is a 5-year bond, this is a 10-year bond, and this is, I think, a 2-year bond. But if you think about it, these are all bonds, and they all are impacted by the same things. And as a result, they all move relatively in sync. So if all the markets are going up, you would expect that a good trade would be to get long and go and try and buy when all markets are going up. So, and conversely, if all markets are going down, it'd be really a smart play to sort of get involved when all the markets are going down. So what we're trying to do is identify spots where the markets are either out of sync or completely in sync. So in this example here, we can see that the Bobl is kind of in the middle of its range. The Bund is actually on its way down, and the Schatz is actually pushing up. So if two markets are kind of up and one's down, then that kind of is almost an example of a spread trade. We're seeing the markets out of sync. So it'll be our job here to try and find an opportunity where there's either buying in the Bund or selling in the Bobl or the Schatz. And that would be our opportunity to make a low risk trade. Similarly, if all these markets are right at the top of their range, I don't think that's a very good opportunity for people to try and pick a top or a bottom in the market, because it's just too difficult to do that, because all the markets are pushing higher. We don't really want to fight the momentum and fight the markets. We should be really looking to go with that and get long in those instances. So it's a very, very quick overview of what we're trying to achieve, but I just wanted to sort of run you through the very, very basics. This will probably not make a lot of sense if you're new to trading with the depth of market, but you can revisit this in a few weeks' time and it'll probably make a lot more sense. But basically, that's what we're all about. So hopefully that's given you a bit of insight, because it's going to take you a few weeks to really get up to speed with this, but I just wanted to sort of try and explain where we're coming from as professional traders and what we're trying to do. So hopefully that's helped you a little bit. If you have any problems, please feel free to ask me. I'm more than happy to try and explain it a bit better than I've done here. Like I said before, trading is a process. It's not going to happen overnight. It's not a matter of just reading a manual and you can do it. You really need to get out there and start really conditioning your eyes to see these opportunities in the depth of market. And it's not going to be easy. It's going to take you, at the very least, a week to really start seeing these things in real time with the depth of market. I know when I started out, I could barely keep my eyes open because it was so difficult to look at these ladders and things. It was so confusing. So I sort of set out a bit of a process where you can run through a series of drills and exercises over the course of a month, and it's going to help you really find these setups, get your eyes used to seeing big buyers and big sellers, and really understanding what we're doing here a lot better, because this is a process. It's going to take a few weeks. I like to sort of think about it like becoming a good golfer. If you were trying to learn golf from scratch and you wanted to become a good golfer, you couldn't really just read a book and then go out there and become profitable, on professional tour kind of thing. You'd need to take, in the instance of a golfer becoming a professional, it would take you years because you're really needing to train and develop that muscle memory. For us, we've got some advantages is that it's not really a physical activity, it's more of a mental thing that we're trying to learn. And you can become quite good at this in really about 30 days. So that's the goal, is to give you a month's worth of exercises to really improve and start seeing these opportunities for yourself. So the first thing we need to do is really set you up with a trading platform, and that's because not all trading platforms are really going to be very good for this. There's only specific ones that we can use to actually see this buying and selling. So I'm going to show you that in the next video, and then I'm going to get you set up with some boot camp and trading drills, and we're going to run you through really understanding how to spot the buyers and sellers, getting you to understand all about correlations and volume profile and all these things that may not make that much sense to you, but we're going to do that. It's going to take you a few weeks, but at the end of that, you're going to be really, really on top of things, and you're going to start seeing how we find these trading setups and understanding how these markets work in conjunction with one another. And like I said, bear with this, give it a few weeks. This is the kind of thing you'd be doing if you were a professional trading firm. You'd be sitting there on a demo account or a trading simulator, and you'd just be practicing and learning and getting accustomed to what this is all about. So don't expect this to happen overnight or even in a week. But if you're prepared to stick with this, this is really going to be your best opportunity to become a consistently profitable trader in the shortest amount of time. So hopefully I didn't rant and rave too much here, and hopefully there's some value for you guys who are just starting out. If you're having any problems at all, or if I'm just not making enough sense, please give me a shout, and I'm more than happy to talk you through anything and get you started on the right foot. So I'm going to be back soon with another video all about getting set up with the right trading platform, and I'll speak to you guys soon.